Many would-be business owners see launching a small business as the ultimate American ideal. Few realize what a steep learning curve it may be. Financial difficulties are only one of many obstacles that small business entrepreneurs must overcome. Many would-be business owners stay on the sidelines for fear of failing. Here's the deal though, mistakes in business won't slow you down, they will only point you in a new direction. If you want to be successful, you need to stay away from bad financial decisions. In this video, we'll cover the 10 financial mistakes that every small business needs to avoid. So grab a pen and paper and get ready to take some notes. Let's dive into the first financial mistake that small business owners often make. 1. Poor budgeting. When first getting started, you could have a rough figure in mind for the total cost of the supplies you'll need. When you are footing the bill alone, it's natural to assume that you can control your spending and keep it within a fair range. Clutch found that about half of all small businesses did not have a documented budget, which may explain why 1 in 5 businesses with 10 or fewer workers did not develop any form of budget. This issue with this line of thinking is that it leaves money in the hands of chance while you operate a company for profit. Without a plan of action, getting where you need to go might be challenging at best. Budgeting should always be done in advance. Having a written plan helps you keep your objectives in mind and motivates you to take action, even if some of those goals need to be adjusted as you go along. 2. Confusing cash and profit. One of the most common financial mistakes made by business owners is misunderstanding cash flow with profit. Imagine you are the owner of a staffing agency that charges $40 per hour to place an employee but earns $50 per hour in revenue. You are operating at a healthy profit margin and should report one at year's end. Let's analyze it a bit more. You've got a $100,000 job to do this week, and you'll make $20,000 in profit. You have costs of $80,000 each year. The customer will pay you $100,000 but not for another 6 weeks. It's impossible to pay employees at this time, in the absence of another source of revenue or $80,000 in the bank. You run the risk of losing your employees and ultimately your company. Being profitable and having liquid assets are two very different things. 3. Making big purchases early on. Numerous items are required by your company. Hardware, office supplies, and stock are all included. There's a chance you'll need some hefty capital expenditures like automobiles or machinery. A place to do business is also required. It's important to remember that it's a typical mistake to assume that you have to buy anything merely because you need it to run. Overspending on costly products may quickly deplete savings. That implies you probably paid more to finance the purchases than you would have if you waited until your company was more financially stable. Don't rush into buying expensive, unnecessary equipment. Instead, focus on the essentials and start small. After then, go around to get the greatest deal possible. If you are in dire need of a costly piece of equipment, it's important to investigate all of your financing choices, such as equipment finance and invoice factoring, to find the most appropriate one for your company's current development stage. 4. Not securing intellectual property. The right that you have to everything that was generated as a consequence of an original idea that you had is known as intellectual property. There is a possibility that your company has intellectual property that you will wish to safeguard from potential rivals. Copyrights, trademarks, patents, and trade secrets are all included in this category, in addition to equipment and other forms of company property. If somebody steals or otherwise infringes upon your intellectual property, you may be able to utilize international rules to pursue legal actions and protect your IP. The laws governing intellectual property differs from country to country. Therefore, to safeguard your interests, you need to familiarize yourself with the intellectual property rules that govern your country. 5. Quick expansion. Entrepreneurs are always one step ahead of their rivals in the market. Small business owners have a sky's the limit mindset. This is why they took the risk of founding their businesses in the first place. On the other hand, expanding operations at an unsustainable rate will almost certainly result in financial failure. Once you begin to see early indications of success, it is not essential to immediately begin expanding your business by establishing more locations, strengthening your computer systems, or employing new personnel. Growing your company will result in an increase in your overhead expenses as well as a decrease in your cash flow. When you have problem with your cash flow, it might be challenging to make payments on a long-term loan, such as a new lease. Sometimes maintaining one's current size and not growing at all might be more advantageous than rapid expansion. It is an indication that your small company requires a chief financial officer if it is experiencing significant development and is contemplating expanding into other locations. 6. Leveraging personal credit for the business. Try to avoid putting your personal credit on the line to support your business. The majority of small businesses have problems maintaining a steady flow of cash. However, very unfavorable outcomes might occur if the owner of a company makes financial investments in the company without first doing a detailed analysis of the implications of such cash investments. My suggestions is that you properly record the procedures and reasoning behind your decisions to loan the money to the company, and that you put boundaries on the amount of money you will lend to the business so that you do not irreversibly harm your personal fortune. 7. Not paying enough attention to the competition. One of the primary reasons why new and small companies are unable to get off the ground is the intense competition that exists in the market. However, the vast majority of company owners start their companies without taking into consideration the fact that there are already established rivals in the field. As a consequence, their enterprises do not succeed. To maintain your positions at the front of the pack, you must familiarize yourself with the strategies used by your rivals. For this purpose, it is vital to have a solid understanding of not only the strong and weak points of your competitors, but also their marketing strategies and a great deal more. If you can get an understanding of your competitors, you will be in a better position to implement the most effective management and marketing strategies, which will allow you to stay one step ahead of them. 8. Not having enough working capital. The term working capital refers to cash that is readily accessible for expenditure. It has nothing to do with the cash flow. This has nothing to do with profits. This is not the emergency money that you have set up. It refers to the amount of money you have in your bank account at any one time that may be used to pay for the costs of running your business. That's where a lot of companies do it wrong when they start their businesses. They believe they can pay their debts because they have a healthy profit or cash flow, but this is not the case. Or, in the event that circumstances get difficult, they believe they can rely on the money they have set aside in their contingency fund. In the event that any of these strategies are used, there is a possibility that the company may be unable to pay its invoices when they are received. If your company is not yet at the point where it can generate enough working capital to meet its day-to-day requirements, you should be prepared with an alternative source of finance in the situations that you run into financial difficulties. 9. Not validating your business ideas. When beginning a new business, failing to do enough market research is among the most significant errors that may be made. You are interested in gathering information about your rivals and gaining an understanding of how you might set yourself apart from them. Competitions might come from other small companies that carry the same things as you do, or it can come from industry giants like Amazon and Walmart. These are instances in which business owners go headfirst into a specialized industry without first considering whether or not the market is a suitable match for their company. There are certain instances in which a particular market segment has a low level of demand and an excessive amount of well-established rivalry. If this is the case, you may want to reconsider basing a company around it. 10. Overhiring. Mistakes in recruiting are common, even in the most successful business. Medium and small businesses can get away with it. When a company is just starting and does not yet have a reliable source of income, it may not be advisable to hire a large number of employees. Having small teams of skilled employees who all work together towards the same goal and help the company expand is essential for new companies. Furthermore, company owners and startup founders need to learn to quickly and effectively terminate workers who consistently provide poor work. Your small company can avoid going bankrupt and huge financial losses by avoiding these 10 common financial mistakes. Maintain a watchful eye on the company's cash flow and use that information to guide strategic choices that will propel its growth and profitability. We appreciate you taking the time to watch. We trust that the information and insights presented in this video will aid you in making wise choices about the financial future of your business. If you have any questions or concerns, don't hesitate to reach out to a financial advisor or professional for guidance. Thanks for watching.